Welcome to the Deep Dive, where we take the high-velocity world of financial filings and really just distill them into fascinating, actionable insights for you.
Exactly.
Today, we are opening the books on one of the three colossal players that, basically shape everything you hear. Warner Music Group Corp. Or WMG.
And our mission today is very specific. We're extracting the critical insights, the really fresh stuff, straight from their latest financial blueprint.
The Form 10K.
The 10K for the fiscal year that just ended September 30, 2025. We're trying to understand how a giant music company like this navigates the streaming revolution, what its biggest risks are.
And crucially, where it's putting its money for the future.
Yes,
Yeah.
because this is a massive, complex business. They're headquartered in New York, traded on NASDAQ, of course, and their core challenge is, well, it's balancing that creative talent investment with just constant technological disruption.
And all the financial regulations that come with it. It's a real tightrope walk.
It is, between art and very complex finance.
Okay, so let's unpack this WMG empire. I think we should start with the structure, because it's really two different businesses under one roof, isn't it?
It absolutely is. The first pillar is what I think most people picture when they think of a music company. It's the recorded music side of things.
The labels.
The labels, Atlantic Records, Warner Records, Elektra, Parlophone, the iconic names. This is the part of the business that produces and markets the actual sound recording.
And this is their engine, right? I was looking at the numbers. For fiscal 2025, recorded music pulled in, $5.408 billion?
That's right, which is 81% of their total revenue. It's huge.
This is where the star power is. We're talking Ed Sheeran, Bruno Mars, Cardi B.
Dua Lipa, the people dominating the global charts.
Exactly. But that success really depends on that second pillar you mentioned, music publishing.
Right, and that's handled mostly by Warner Chappell Music, if recorded music is, let's say, the finished movie.
Then publishing is the screenplay.
That's a perfect analogy. It's the screenplay. They handle the rights to the musical compositions themselves, the notes, the lyrics.
The blueprint.
The blueprint. And their catalog is just gigantic. Over 2 million compositions. I mean, from more than 190,000 songwriters.
So you've got artists like 21 Pilots, Lizzo, Katy Perry in that catalog.
Yep. And publishing generated a smaller but still very healthy $1.306 billion in fiscal 2025. That's the other 19%. It's a long-term IP game.
And to run this whole thing, this dual empire, they have a surprisingly lean team. Right. About 5,500 people worldwide.
It is lean for their scale. But even with that scale, and this is a crucial point, they are the smallest of the big three.
The oligopoly.
It's an oligopoly, absolutely.
Yeah.
In 2024, WMG had about 15% of global recorded music revenues.
Okay, so who's ahead of them?
They're trailing Sony Music, which has about 23%, and then they are way behind the undisputed market leader, Universal Music Group.
UMG.
UMG commands a massive 32% share.
So when WMG talks about growth, they can't just throw money at the problem. They can't outspin Universal or Sony.
No way. Their margin for error in finding the next global superstar is it's much, much thinner.
Which is why their focus on tech and data is so important.
It's their edge. It has to be their edge, beyond just pure financial muscle.
That surgical focus brings us to their core revenue driver, digital. And they were pretty early to this game.
They were. They actually earned some bragging rights back in 2016. They were the first major company to report that streaming was their largest source of recorded music revenue.
And the numbers really back that up.
Mm-hmm.
Globally, recorded music revenue grew at, a 10.6% compound annual growth rate from 2020 to 2024?
A really impressive CAGR, and almost all of that was driven by streaming, which grew at 13%.
And for WMG specifically?
Their recorded music streaming revenue grew at a 9% CAGR over that same period. By the end of fiscal, this is the massive opportunity. For us in, established markets, streaming feels like it's everywhere, but globally, the runway for growth is still enormous.
Okay, let's put some numbers on that because they're kind of shocking. Goldman Sachs estimates for 2025, which WMG references.
Right.
In an early market like Sweden, paid subscribers make up something like 67% of the population.
Okay, 67%. Now compare that to the U.S.
The U.S. is around 57%. The UK, 50%. Germany, 41%. So even in these big markets, there's still room.
But the real prize, the long-term play, is the emerging markets. Look at Brazil.
Just 19% penetration.
19. And then you look at India, a nation of, what, 1.5 billion people?
It's a tiny 3%.
3%. WMG knows this is their growth engine for the next decade. This massive, largely unmonetized population.
So you have this staggering potential. But here's the irony. Even if they capture all that growth, their profitability on the publishing side,
The blueprint,
is capped by regulations right here at home.
This gets a bit dense, but it is so vital. A huge chunk of their publishing revenue is dictated by government rate setting. The U.S. Copyright Royalty Board, the CRB.
And what did the latest ruling, the Phone Records, the fee, say?
Well, it set the mechanical streaming royalty rates. That's the payment to the songwriter every time a song is, reproduced on Spotify or Apple Music.
And the rate is?
It's locked in. It's set to escalate from 15.1% of total music revenue in 2023 up to 15.35% by 2027.
So even if their recorded music side drives explosive growth, the publishing side gets a fixed, government-regulated slice. It limits their upside.
Exactly right. It's an asymmetrical risk. And even for physical things like vinyl, the rates also saw mandated increases. It's a permanent feature of their business.
Okay, let's shift from regulatory risks to strategic vulnerabilities. The 10K highlights one that seems absolutely critical: digital distribution concentration.
This is the bottleneck, the strategic bottleneck. WMG is just so deeply dependent on a very small handful of massive digital music services.
How concentrated are we talking here? What's the number that really makes you sit up and take notice?
Okay, get this. The top 3 digital accounts. So that's Spotify, Google, YouTube, and Apple.
The usual suspects.
The usual suspects. Together, they accounted for approximately 43% of WMG's total revenue in fiscal 2025.
Wow, 43%. So nearly half their money flows through 3 tech companies.
It's an incredible amount of leverage for those platforms to have. And to make it even more real, Spotify alone was 20% of their accounts receivable balance.
So if Spotify has a bad quarter or tries to renegotiate terms,
WMG feels it immediately. It's a massive concentration risk.
which makes the next risk, the corporate control structure, even more interesting. Because if you're a regular person buying WMG on NASDAQ,
Your influence is basically zero.
practically zero.
Yeah, you're hitting on their controlled company status. Access Industries, the controlling stockholder, holds about 98% of the total combined voting power.
98%. How is that even possible?
It's the dual-class share structure. Access holds the Class B common stock. And those shares, they get 20 votes per share.
Compared to 1 vote for the Class A stock that you or I would buy.
Precisely. So Access has near absolute control over everything important. Electing directors, mergers, corporate policy, you name it.
So for a public investor, you're just along for the ride. You're betting on management, but you have no say.
None at all. It's a structure built for one shareholder's long-term vision.
And beyond these structural things, there's always the inherent IP risks. The competition for talent, but also that legal shadow over their back catalog.
The recapture, right, that's the perpetual threat. This idea that artists might be able to recapture the U.S. copyrights to their own recordings after a certain period.
Under the U.S. Copyright Act.
Right. And if they lost the rights to some of those golden oldies, the ones that generate steady, reliable streaming money, it could be catastrophic.
So to navigate all this, WMG is clearly trying to get lean and mean. They have these big restructuring plans.
The 2024 and 2025 strategic restructuring plans. And they were costly. The 2025 plan alone had $90 million in severance and termination costs.
$90 million.
Plus another $28 million in impairment losses. They're clearly cutting deep to shift resources toward digital.
And away from legacy analog processes.
Exactly. It's a tangible, very expensive commitment to streamlining the organization, to chase that global growth we talked about.
Okay, so let's pivot to that. What are they actively investing in to drive future growth? The filing mentions 3 priorities.
Yeah, it's growing market share, growing the value of music, and increasing efficiency.
And a key part of that seems to be A&R technology.
Yes. They acquired a company called Sodatone. It's an advanced A&R tool. Think of it like a data-driven talent scout.
So instead of relying purely on an executive's gut feeling,
Which is, famously hit or miss.
they're using data, streaming numbers, social media trends, touring data, all to pinpoint breakthrough talent before they get too expensive.
It's like Moneyball for music. They're trying to find undervalued assets by being smarter and faster with data. It changes the whole game.
And you see that same innovation focus in how they approach new platforms. They want to be first.
First to strike deals, first to figure out monetization, not just with the big three, but with, Peloton, Twitch, Tencent in China.
All places with unique licensing models. It's a way to diversify away from that 43% concentration.
They have to. And looking forward, their biggest focus now seems to be on artificial intelligence.
Which is both the biggest opportunity and the biggest threat.
It's the next frontier. They're working with partners, generative AI engines, to figure out how to use AI to benefit artists, but they're also being really cautious.
Trying to write the rules as the game is being played.
Exactly. They're trying to build in the legal protections and monetization rights now before it completely upends the creative process.
And to fund all this, let's just touch on their financial stability. Are they on solid ground?
Their foundation looks pretty sound. Their total net debt was about $4.365 billion.
Which sounds like a lot.
It is, but what's impressive is how they've managed it. They've reduced their weighted average interest rate from a painful 10.5% back in 2011 all the way down to a much more manageable 4.1% now. That's fantastic debt discipline.
And it frees up a lot of capital. Plus, their nearest debt maturity isn't until 2028.
Right, so they have breathing room. That plus a $350 million revolving credit facility gives them the flexibility they need for this big transition.
So this deep dive really paints a picture of a company, aggressively adapting. They're using strategic cuts and data-driven tech to chase that huge global streaming opportunity.
But they're doing it while navigating these massive inherent risks, the revenue concentration with Spotify and Apple.
And that government-imposed ceiling on their publishing profits.
Which leads us to, I think, a final provocative thought for you to chew on. WMG is actively developing AI monetization pathways. They have to. Given that forward movement, how quickly will the legal and commercial definition of AI usage completely revolutionize what a musical composition license even is?
I mean, who gets paid for what?
Exactly. I think in the next 5 years, that definition is going to change so fundamentally that it will force a total rewrite of the publishing blueprint. And that revolution, both commercial and legal, is something you absolutely need to keep tabs on.